Hi, it's Frank Cappelleri from Cap Thesis. It's a pleasure to be with you here again on Stockcharts TV. So today we're going to look at the S&P 500, a number of key ETFs and asset classes as we end the third quarter of September of 2025 and begin the fourth. So as you can see here, the title of today's piece to Cap Thesis clients was, surprise, September was also boring. Now, one way to see this is by looking at seasonality. And we can do that easily by using some Stockcharts.com tools. In fact, go to Charts and Tools here, More Charting Tools, and click Seasonality, and this comes up. And so you can really pick from a host of different indices, ETFs, etc., and it gives you the ability to go back a number of years to look at the seasonality per month, right? It tells you the average gain or loss for that month and the percent of the time that in particular entity is higher, right? As we can see here, September, no surprise to anyone, was only up 55% of the time over the last 20 years with a marginal decline, which makes it one of the worst in terms of win rates for the month and also the average move. And we've heard many of these studies over the last few weeks, especially coming into September, right? Negative seasonality or at least subpar seasonality. Volatility tends to return in September. Volume tends to increase just because kids are going back to school, which means people are going back to work full time as well. The Fed was about to cut rates. That was going to be classic sell the news event. And of course, if there's negative or subpar seasonality for the S&P 500, it means a positive seasonality for the VIX. Now, this goes back 5 years, not apples to apples, but I think it's very interesting to see that over the last 5 years, the VIX was up every single time. So in September, as we can tell, it's pretty immediate advance. Now, we know the VIX can move pretty quickly in terms of percentage terms, but again, all of this was out there as we entered September, including the fact that, especially that all of this tended to have come in the second half of the month. So here we are on the last trading day of September 2025, and what do we have? Not a lot of change, right? This is just all the price action going back to the very beginning of the month, first trading day here on September 2nd, as we can tell. Not a lot of bright red or bright blue for that matter, other than the continued small amount of new 52-week lows, right? So as we can tell here, there wasn't more than a gain of 80 basis points in any given day so far, and the biggest loss was 70 basis points, which means that there's still isn't a lot of 1% moves. And again, we track this because it's two-way volatility. It tells exactly what's going on. And again, we didn't show anything in terms of what the trend was on this chart and just showed you the amount of 1% advances and declines, which are depicted on this chart. You would know exactly what the type of market that we're in. And of course, it's one that continues to float higher with hardly any pullbacks to speak of, right? And for the month, that means so far, again, with just a few hours left as this is recording, 0.1% gains, 0.1% losses, which is important because it will be the second time this has happened in the last 3 months. And remember, we talked about this at the time. In July of 2025 was the first time it happened since December 2019. So we're talking about a number of years, some very good years, especially 21, 23, and 24, where this hadn't happened at all. And with the count coming after the insane amount of volatility induced by the tariffs on the way down, it was an extremely unlikely scenario to play out. And now, again, it's happened 2 calendar months in the last 3. And here is the current tally. We showed this again as July was ending, that, again, so far, 2025 has one of those months, possibly 2 right now. Last time we had one, we talked about in December 2019. And as we can tell here, very few months over the last 20 years where there was more than 1 month with 1% gains or losses. 2 years I wanted to focus on today was 2018 and 2017. Now, 2017, not surprising at all. We talked about this various times. We know it's the best or most consistent uptrend on record, right? There were only 8 1% moves all year, 4 up, 4 down. So not surprising that 6 of those months had 0.1% gains and losses. What's surprising to hear, though, was 2018 is in this tally or is on this table as well for having 3 happening, right? In July, August, and September. This is important to recognize, and here's why. So if we look at this on the chart, here's 2017, 2018. These are all the months highlighted here with, again, 0, 1% moves. And so 6 of them all scattered around right within 2017 as the market continued to float higher. And so, as we know, there's been a lot of comparisons to what we've seen over the last few weeks and months to 2017 because of this very reason. 2018, though, not so much, at least not lately. As we came into the year, yes, because that was when Paris talked about really the last time. And what happened? Beginning of that year, we had that huge vol implosion to begin, and it stayed volatile really until April. And then from that point, things changed. The volatility didn't completely disappear, as we can tell. Number 1% moves stayed with us until we got to July, August, September. And again, 3 straight months, the 1% losses or gains as the market not only came back, but overtook that prior high, that spike high, right, to begin 2018. And just when we thought everything was going back to normal, really continuing what we saw from 2017, the bottom fell out, right? Initially, as October began, a lot of back and forth movement through the end of October, November, and then the big whammy was December, down overall 20% from peak to trough, all in. And so, as we can tell, again, we just talked about the similarities to 2017. So now there are pretty good comparisons we can talk to about 2018 as well, because as we know, 2025 and 2018 started with a lot of volatility, and now we've risen in a very consistent way, just as the third quarter is ending, right? And so we're not making any predictions here. What happened back then was, guess what? Bullish pattern started to fail, bearish pattern started to work. So if and when that starts again, potentially, anytime, we'll recognize it and act accordingly, right? Those are the things we'll be watching in terms of price movement for the S&P 500 as the fourth quarter begins. So in terms of patterns right now, we just have that same 67.45 target. Again, that has been in place since May 12th, was tested within a few days or a few weeks even here, and then off we went. So we're still waiting to see more patterns form at this point. Talked about how just in the last few weeks, we had 2 additional upside targets hit. So it's really going to be up to the market to decide whether one of these consolidation phases is finding the leverage to the downside. Talk about it from a classical pattern perspective, talk about it from a trading box perspective as well. And that's clearly something we'll be watching going forward. So next, we're going to move away from the S&P 500 and focus on a few key ETFs. But before we do that, I remind you that we have a free Substack newsletter called Cap Notes, where we talk about all of these points and a lot more, often share full-length premium pieces like we did this morning, along with videos and other thought pieces. So again, it's capnotes.substack.com. Look forward to seeing you there. So let's start with MSOS Cannabis, which continues its volatile yet very strong comeback. So as of Monday, September 29th, it just gained another nearly 30% in one day, right? So this is a weekly chart. As we're talking about to our clients about this in terms of how to trade it, right? Number one is recognize the fact that it's forming a potential very strong bullish cup and handle pattern here on log scale. We have to look at this at log, of course, because it's so low price and has come from such a high level that otherwise this wouldn't look like anything yet, right? And so in terms of log, we can see, number one, that it respected resistance right where it should have, right? The 6 area here. And then pull back, as you would think. And best case scenario at that point was going to be seeing what? A higher low, which so far has been the case, right? Held right here as well, right where you thought it would have, as an area of support back from the beginning of 2025, right? And so again, for a trading vehicle, this could become tricky. Number one, because the percent moves are just wild, right? Monday was an extreme move, right? The biggest one we've seen in 3 years, but there's been strong moves regardless, just because it's so low price. So in terms of managing risk, it's really better to use a wider stop from that angle. It's because you can get stopped out multiple times a day if we use, say a normal 5, 10%, whatever trailing stop loss that you like to use. So, if you're going to trade one of these, you want to remain in it for longer and potentially attempt to ride this if it continues to move higher, then use a wider stop. Now, that, of course, gives the risk of having to endure a lot more of a pullback. So the way around that, of course, is to use smaller position sizes. So you can still trade in one of these the way you would do. These are two very simple strategies you can employ. Again, wider stop losses, smaller position sizes. So that is something we'll be watching into the new quarter to see if we eventually can get back to the 6 level and stay above it once we break through that area. XBI Biotech also has been doing very well, as we know, and it's really a picture-perfect example of the staircase-like advance categorized by trading box breakouts, right? Had 4 of them so far. Each of those happened after the cup and handle breakout, which simultaneously broke a key downtrend line. So right now, after the most recent big move, wouldn't be surprised again to see another trading box, another consolidation phase take hold. And as it does that, it's getting very close to actually achieving this couple handle pattern, which would get it close to 100 and then closer to the 105 area. Now that's very important because 105 is the top of this really long trading range. We have this colored in green and red for obvious reasons, where the most interested buyers, of course, happened after the ETF has fallen to various times over the last few years and dropped back to, say, under 70 to 65. Seen some very strong moves start from that point, including the last one. Some of them, the best ones, though, faded as they got back to the mid-90s and above. So needless to say, there are going to be a lot of interested sellers or short sellers if and when we go back up to that spot. And the onus now is on the bulls to take control and show that there's actually demand at higher prices as well. And if that happens, we can see how this potentially could turn into an inverse head and shoulders pattern as well. Left shoulder, head, potentially then, rising to 105, pausing there, and then taking it from that point. So if that happens, that could really take some time to play out. And that's why we want to focus on the daily action first and see how those next set of consolidation zones play out, right? We know that they've all been consolidated. We see the digestion coming and we wait for the next breakout. If and when that does not happen, then we'll have to readjust. But that is another one we'll be focusing on into the new quarter. Bitcoin, of course, continues to be on everyone's radar screen, as it should, because as we know, it's a risky asset class and it's correlated positively to the S&P 500 and many other areas. So with it pausing recently, or having made its last high a few weeks ago, it continues to diverge from the S&P 500. Now, that's one way of looking at it. Secondly, we can look at this, or we can view this on a weekly chart, and it just appears nothing has changed so far, where these are just a number of downward sloping trading channels. We can call these bullish falling wedges, whatever they are. You can tell that when this has happened over the last 2 years, it's just a matter of time before that next big up leg took hold. And that led to some strong moves along the way. This one is taking longer to unfold. And so, as you may have heard, seasonality tends to do a lot better in October and November. And again, using that same chart tool from Stockcharts.com, we can see this. This is going back 12 years, as much history as it has here. And September, as we can tell, up only 42% of the time, an average move of negative 4%. And that really changes, though, when you get to October. In fact, it's the best in terms of win rate, 82% of the time, tied with February, but the percent move average is nearly 20%. And we know how fast Bitcoin can move, so it could obviously move much faster than that, but with it happening in October over and over again, we can see how this has resulted in positive seasonality. And so, again, it will be a perfect time for that last bullish pattern to eventually get broken out from, especially since there's another bullish pattern involved as well, right? This inverse head and shoulders pattern we're talking about. We don't have it here today, but that continues to have an upside target of 142,000 as long as Bitcoin holds around that 109 area, which continues to test over the last few weeks. Now, in terms of gold, as we know, has had a huge advance over the last few weeks, especially September, right? And so this is the same time frame as we shown in Bitcoin, starting in late 2022. It's been a series of really impressive breakouts, right? And it's, again, up a huge amount, but it's all been about utilizing or leveraging these extended pauses and then finally busting through resistance and having that follow-through move come almost immediate and extending much further, actually, than even getting to that target, right? We've seen this now 1, 2, 3, 4, and this is the 5th time. As we can tell, way above the target at this point, producing yet another overbought reading. Now, in terms of seasonality for gold, it's actually done extremely better than what we've seen, again, going over the last 12 years to compare it to Bitcoin. In fact, September in the past, gold was only up 25% of the time. So a tiny, very low win rate, an average move of just negative 1.1%. So from this perspective, seasonality hasn't mattered at all. This is just as taken off, and we can see how momentum can get behind anything, including gold. And so for October, it tends to do even better, up 55% of the time with an average move of positive 1.1%. So from this perspective, it could suggest that this could continue. So we had to choose between gold and Bitcoin for October. Which one should we choose? Well, in terms of following the trend, gold has been doing much better, but this is how it looks on a relative basis. First, from a seasonality point of view. And so again, even though gold has been higher over the last 12 years, obviously not compared to Bitcoin. And in fact, Bitcoin still is up 82% of the time versus gold with an average move of nearly 19% on a relative basis, again, versus gold. And this is what it looks like on the chart. This is a daily chart, Bitcoin versus gold over the last few years, going back to the beginning stages of 2023. As we can tell, a series of higher lows along the way, but there's been periods of pullbacks too. We know gold's been doing pretty well over the last few years, and so that has produced near oversold readings now 4 times after what's happened over the last few weeks. And this didn't really nail the low every single time, but as we can tell, getting to near oversold levels, especially the second time it's happened along the way here during the past occasions, clearly occurred closer to a low of Bitcoin versus gold as opposed to a high. So that suggests once more that perhaps the outperformance of gold versus Bitcoin could be coming to an end, or at least coming to a point where we'll see that flip once more. And again, it makes sense from a seasonality perspective and an indicator perspective here on a daily basis for that to work. Zooming out with the same chart on a weekly basis now, we can tell that, of course, it continues to be in an uptrend versus gold. And a few times that it came back down to this line happened after Bitcoin has crashed. As we know, some huge drawdowns over the years, specifically after the 2017 peak here and 2020 peak. So that's important to recognize. So does that mean we need Bitcoin to crash from here even more just to get back down to this lower trend line? That's one way of thinking about it. But one thing we haven't had just yet is a parabolic move after seeing a rally. That's what basically led to those crashes on the way back down. So potentially, what could we have? We could have Bitcoin start to outperform in October or November, causing that move to be parabolic into the end of the year, which would, of course, mean that the positive seasonality is taking hold, as is the rebound on an oversold basis versus gold as well. And then taking that a few steps further, maybe we'll get that bigger down move in Bitcoin into 2026. Let's not jump a few steps ahead, but these are some of the key charts we're watching as October and the fourth quarter begin in 2025. Thanks, and I'll see you next time.